Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today. So Dan, in terms of that first question, I suppose considering what the world looks like at the moment with inflation, interest rate pressures and everything happening in the world, where do you guys or where does Lonsec see kind of share investment happening in today's market?
Thanks, Martin. Look, at a high level, I mean, from a sector perspective, the value and cyclical oriented sectors do tend to outperform in an inflationary environment, and that's because the businesses within these sectors tend to have a higher earning sensitivity to higher interest rates and inflation. And these sectors, examples include financials, resources, and energy. So natural resources and financials are some of the key sectors that do benefit from high interest rates and rising inflation. And at the same time, at the other end of the spectrum, the duration and growth sectors of the market do tend to underperform at these times as higher interest rates and inflation tends to have a negative impact on the relative valuation of these sectors. And that's particularly important now because we've just enjoyed over a decade of ultra low interest rates and inflation, and obviously that's changing as we speak. So we're seeing a rotation between these sectors, these two factors at the moment. And on that side, from an example, sectors include technology, healthcare, and defensive growth sectors like consumer staples are underperforming. And the key part of the reason for that is once again they're being grouped in that growthy quality bucket, which is being devalued or derated because the market is pricing in certain expectations for interest rates and inflation. And they don't tend to benefit as much when things are not going so well, and at the same time when interest rates are rising and the economy is strong, the businesses are still tend to do well. So this is purely a derating from a valuation and an underlying sort of momentum in market sectors.
And so that's not saying, I suppose, arguably they're less profitable, but it's saying there's less growth in that space, or like on that, like if. So Coles or Woolies, the price of things are going up. Well, surely they'll pass on the consumer, but effectively their margins being into, or they think the consumers will just spend less.
Look, historically speaking, inflation has been a positive for the supermarkets because they tend to have the capability of passing through those price rises, and obviously on absolute terms, it's positive for their sales growth. And particularly given the dominant nature of the two key providers in the Australian market. So look, the margins are getting impacted, but there's a number of reasons for that. It's not just inflation. There's been COVID-related costs coming to the system. There's lack of available labor in some pockets of the market. So, but it's not dramatically impacting their margins. So overall, as a basket, if you look at the technology, the healthcare, and the staples sectors, there are no real negative impacts from an earnings perspective. These are really solid, strong businesses. Some of them benefited through COVID, some of them not as much. But these are solid businesses that are not reliant on the underlying macro economy to do well. And as we saw, those two sectors did really, really well during the drawdown in the pandemic. So basically what's happening is the lower quality companies tend to need a stronger underlying economy to do well, whereas these businesses don't. So what's happening is that there was a flow of money into these sectors in the lead up to this period or in the last decade per se. But now, because there's tangible evidence of higher interest rates and inflation, the valuation multiples the market is prepared to pay for these businesses is reducing. And that's what's driving the underperformance.